Most losing traders aren't traders at all. They're casino players who happen to use charts. That sentence annoys people because no one likes being compared to a gambler. Traders analyze. They plan. They talk about risk. Casino players chase lights and luck. At least that's the story we tell ourselves. But when you strip away the language and look at the behavior, the difference is smaller than most people want to admit. Screens flashing, prices ticking, wins creating excitement, losses creating urgency, bigger bets after a good run, desperation after a bad one. The emotional rhythm is almost identical. Different venue, same psychology. Most traders reject this comparison immediately. They say they're not gambling because they use indicators, strategies, or models. They say gamblers rely on luck, while traders rely on skill. But the market doesn't care what you call it. It only responds to how you behave when money is on the line. Here's the uncomfortable truth. Many traders aren't trading expectancy. They're trading emotion. They're trading boredom. They're trading hope. They enter because they feel like they should be in a trade. They stay because they don't want to be wrong. They increase risk because they want to feel something change. Meanwhile, a small group approaches the market very differently. Same charts, same instruments, same sessions, but no thrill, no chasing, no emotional attachment. They're not trying to win the next trade. They're executing a process that doesn't care how the last trade ended. The difference isn't intelligence or experience. It's intent. And once you see that difference clearly, you start to understand why so many traders lose the same way gamblers do. Part 2. How trading turns into gambling. Most people don't come to the market intending to gamble. They come to trade seriously. They open accounts with discipline in mind. They talk about rules, plans, and long-term goals. But somewhere along the way, the behavior shifts. Quietly, gradually, almost unnoticed. It starts with the way the market pays attention. Every click has an outcome. Every trade gives feedback. Win or lose, something happens immediately. Your brain latches onto that. The market becomes a machine that responds to you in real time. And the faster that feedback comes, the more powerful it feels. Wins don't just add money. They add excitement. Losses don't just remove money. They create tension and urgency. Over time, trading stops being about execution and starts becoming about how you feel while you're in it. You trade when you're bored. You trade when you're frustrated. You trade when you want to recover a loss or extend a winning streak. Without realizing it, you're no longer following a process. You're chasing a state. This is where outcome obsession takes over. The trade itself stops mattering. Only the result does. A winning trade feels good, so it must have been a good decision. A losing trade feels bad, so it must have been a mistake. That's exactly how casino players think. They judge decisions by outcomes instead of probabilities. They learn the wrong lessons because the feedback is random in the short term. The market makes this worse by rewarding bad behavior just often enough to keep it alive. A reckless entry wins. An oversized position pays off. A rule-breaking trade works. Your brain logs it as confirmation. Next time you push a little harder, you bend the rules again. And when it eventually goes wrong, it feels unfair. Like the market took something from you that you'd already earned. That sense of unfairness is a giveaway. Professional traders expect losses. They've priced them in. Casino players feel robbed by them. They don't see losses as part of the cost. They see them as setbacks that need to be corrected quickly. So they press. They increase size. They shorten their patience. They trade more. Another sign is how risk is treated. Gamblers fear losses, but they also flirt with them. Risk becomes emotional. Sometimes they avoid it. Sometimes they embrace it recklessly. There's no consistency. In trading, this shows up as changing position size based on confidence, recent results, or mood. The risk isn't fixed. It's negotiated in the moment. There's also the issue of random reinforcement. Good trades lose, bad trades win. Over time, this scrambles judgment. You stop trusting the process because the results feel inconsistent. So you start interfering. You tweak entries. You exit early. You override rules. Not because the system changed, but because your confidence did. This is how traders drift into casino behavior without ever stepping into a casino. They're not rolling dice. They're rolling emotions. They're not hoping for luck. They're hoping to feel relief, excitement, or validation. The trade becomes a vehicle for emotion instead of a calculated decision within a larger series. You can usually spot this behavior by how a trader approaches a session. Casino-style traders trade when they feel like trading, when they're tired, bored, angry, or overly confident. The market becomes something to engage with, not something to operate within. Their schedule is emotional, not conditional. There's another type of trader, though, one that looks almost dull by comparison. They trade the same way regardless of how they feel. They don't increase size after wins. They don't chase after losses. They don't need the market to entertain them. Their trades look repetitive. Their days look quiet. From the outside, it's hard to tell what they're even doing. The key difference isn't knowledge or experience. It's the relationship with uncertainty. Casino players try to escape it. Professional traders accept it. One needs action to feel okay. The other is comfortable waiting. Until that difference is understood, most traders will keep repeating the same pattern. They'll call it bad discipline or poor psychology. But at its core, it's simpler than that. They're approaching the market with the wrong intent. And as long as that stays the same, the results won't change. Part 3. The line between trading and gambling. The difference between trading and gambling isn't the market, the instrument, or even the strategy. On the surface, they look the same. Money goes in, money comes out. Risk is involved either way. The difference sits deeper in how uncertainty is handled. Casino players operate on hope. They need the next outcome to go their way. Even when they talk about odds, they're emotionally invested in being right now. Losses feel personal because they interrupt the story they're telling themselves. Wins feel validating because they temporarily erase doubt. Professional traders operate on probability. They don't need the next trade to work. They need the next 100 to behave as expected. Single loss doesn't threaten them because it was accounted for before the trade was placed. It's not a surprise. It's a cost. This is where intent becomes visible. Gamblers ask, "How much can I win on this trade?" Traders ask, "Does this trade fit my rules?" One is outcome-focused. The other is process-focused. One is emotionally exposed. The other is structurally protected. Rules are the dividing line. Casino players treat rules as guidelines. They follow them when it's easy and bend them when emotions rise. They move stops when it feels uncomfortable. They increase size when confidence is high. They justify exceptions because the moment feels different. Traders treat rules as identity. They follow them especially when it feels wrong to do so. Not because they lack emotion, but because they've accepted that emotion is unreliable in the short term. Rules exist to protect them from themselves, not from the market. Risk is another giveaway. For gamblers, risk feels threatening. It creates fear, excitement, or both. They try to avoid it, then suddenly embrace it to recover losses or amplify wins. Risk changes based on mood. For traders, risk is fixed. It's a business expense, known in advance, boring by design. This changes how losses are experienced. A gambler feels pain and urgency. A trader feels confirmation that the system is working as designed. Losses don't trigger action. They trigger continuation. The next trade is taken the same way as the last, without adjustment or revenge. Over time, this creates a completely different relationship with the market. The casino-style trader needs engagement. They need stimulation. They need something to happen. The professional trader needs alignment. When conditions aren't there, they wait, and they don't suffer while waiting. This is the moment most people misunderstand. Waiting isn't passive. It's active restraint. It's choosing not to participate when participation would be emotional rather than logical. It's declining trades that look tempting but don't meet the standard. That ability alone eliminates most losing behavior. Most losing traders aren't missing information. They're missing structure. They're not undisciplined because they're weak. They're undisciplined because they're operating without a clear line between what is allowed and what isn't. Without that line, every decision becomes negotiable. And once decisions become negotiable, emotion always wins. When that line is drawn clearly, something shifts. Trading stops feeling like a game you're trying to beat and starts feeling like a process you're managing. You stop asking whether the next trade will work and start asking whether it should be taken at all. That's the real separation. Not trader versus gambler, but operator versus participant. One plays the market, the other operates within it. And until that distinction is made, no strategy, indicator, or amount of effort will make a lasting difference. Part 4. When trading stops feeling like a game. The shift away from casino-style trading doesn't arrive as a dramatic moment. There's no sudden realization, no emotional breakthrough. It shows up quietly, in how behavior changes when nothing is happening. One trader I know used to treat every session like an event. If he was in front of the screens, he felt the need to participate. Win or lose, he wanted action. Some days ended green, some ended red, but almost all ended mentally exhausted. When he drew a hard line around his rules, everything slowed down. Same strategy, same market, same hours, but far fewer trades. At first, it felt empty, like he was missing something. Then, something else happened. His losses stopped escalating. His wins stopped feeling urgent. He no longer felt the need to get involved just to feel engaged. His results didn't spike overnight. They stabilized. And stability was what he'd been chasing the whole time without realizing it. This is what trading looks like when it's no longer gambling. Most of the day is uneventful. You watch price approach levels and do nothing. You let setups pass without regret. When a trade appears, you take it without excitement. When it loses, you move on without frustration. There's no emotional charge because nothing is being proved. At this point, identity changes. Casino players see themselves as participants. They need the market to respond to them. Professional traders see themselves as operators. They don't need feedback from the market to feel valid. Their confidence comes from execution, not outcomes. This is also where boredom enters the picture, and boredom is the signal most people misread. Boredom doesn't mean you're doing it wrong. It means you're no longer feeding on stimulation. It means you're no longer outsourcing emotion to the market. Boredom is what consistency feels like before it looks like anything. The market doesn't reward excitement. It doesn't reward boldness or intensity. It rewards restraint. It rewards people who can sit with uncertainty without turning it into action. The traders who fail are looking for movement. The traders who last are looking for alignment. At some point, every trader faces a quiet choice. You can treat the market like a place to feel something, to chase, to recover, to escape boredom or frustration. Or you can treat it like an environment that demands structure, patience, and emotional neutrality. Both paths exist. The market doesn't care which one you choose, but only one of them leads to consistency. Only one of them removes drama instead of amplifying it. And only one of them turns trading from a game you're playing into a process you're running. If you want to keep exploring these kinds of insights, trading stories, and mindset shifts, keep following the channel as we share more trading perspectives and motivation in future videos.